to all of you who have any exposure to private equity as an asset class in the room, I will hope that you'll find this relevant, because what I'm going to be talking about is at the very heart of what drives this asset class, namely, what are the things that you can really credibly and reliably look at from the rearview mirror, learn and read from a track record of a private equity fund manager that will really allow you to learn something about their likelihood of being part of the famous outperformers and top quartile going forward. So I want to very briefly start out just with a few, admittedly slightly cynical comments about the quest for the holy top quartile. And we all heard the joke that private equity is the only asset class where 75% of the populations are in the top quartile, which would drive my statistics professor crazy. And I want to share with you a bit of research I've done quite some time ago already to kind of figure out what's behind that particular myth. And one thing that's striking in private equity, in the buyout space in particular, is to see if you look at where the benchmarks providers sit in terms of what they classify as a top quartile fund, an average performance fund in the same vintage year and the same geography, you actually see dramatic disagreements here. You have the vintage years on the chart. This is from about the same thing from the two different data vendors, and you see the dramatic differences vintage year by vintage year. Now, if you look at the vintage year 2001, one source says the average performance was a 31%, the other source says it was a 12%. Now, if you're a 20% kind of guy, you immediately know where you want to be benchmarked against. Now, if you follow that reasoning and you admit that funds, of course, have a flexibility in how to be benchmarking themselves, you very easily find out that indeed 66% of all private equity funds, drawn on a representative sample that I have access to at the university of 500 fund managers, 66% of those funds can legitimately claim to be top quartile. So I thought, okay, it's not quite three quarters yet, so I'm going to push it a little harder. And I brought in that other element of ambiguity, namely the fact that the vintage year itself is far from being legally clearly defined, right? For some, it's the first investment cash flow. For others, it's the first close or the final close or the final close. So that can easily run into the next calendar year. And if we add that additional flexibility, so if those funds get to choose which data vendor I want to be benchmarked against, and do I want my vintage year or the adjacent vintage year, the number of funds that can legitimately claim to be top quartile jumps to 77%. So the good news is nobody's really lying when they're all saying they're top quartile. The bad news is the whole benchmark in private equity is, let's say, suboptimal at least, and just the criterion of being top quartile is not necessarily really very meaningful. So, but of course, why are we worried about the whole top quartile? And we're worried about it because we want to try to learn something from the past that allows us to predict the future, that allows us to get a portfolio that going forward will outperform. And looking at this systematically, it's important to understand what we really talk about when we talk about performance persistence. Is it the significance in performance in the sense that if I have somebody who has high performance in the past, he'll be high performing again? Or is it the performance in the sense that if they were top quartile, they're going to be top quartile again in the future, which is similar to the first point, but not quite identical? And the third one is really, to me, the most important one. If I find who was top quartile in the past and I invest with those GPs, do I actually get a higher performance in the future? That's ultimately what's driving it. And academic research has touched on a variety of those elements. And I recently took a fresh look at this based on a large sample of over 2,500 funds overall, on which we know detailed cash flow over time. And in this data set, we identified roughly 200 fund pairs. So one fund and its successor funds by the same GP from the same geographic region with the same strategic focus. So those are the funds where you would say, okay, I invest with one fund and then I observe performance in one fund, I invest with the next follow-on fund, and then see what performance looks like. So let's try it out. Let's look at what we're all used to, namely the performance indicators of the total money multiple or the IRR. And basically what you find there in terms of statistical significance is there is really no link. There's no statistical increase in the performance of your portfolio if you back past performers based on IRR or TVPI. Now that may be counterintuitive to many of you who have kind of been told about performance persistence and you've read the academic literature about performance persistence. But the truth is this type of work has been done in the 80s and the 90s There was performance persistence at the time. It went away. And we're going to see in a second why it went away, and importantly, what you can do about it, namely switch to a smarter performance measure to still actually get to performance persistence. Now, talk about performance measures. What's typically done is to look at this in terms of the internal rate of return, as everybody does, as a measure of absolute performance. And then some people start to use kind of this public market equivalent type approaches to get to a measure of performance relative to public market investments. There's a fundamental methodological issue with the IRR measure. I'm not going to bore you with this. I think it's reasonably well documented. People haven't fully endorsed how dramatic this bias is, but I'm going to show you some data that indeed it is distorting the whole performance assessment quite dramatically. And I've proposed two alternative improved performance measures, an annualized rate of return that measures absolute performance, and then an alpha type measure that measures relative performance, circumvening all the issues with IRR. And in a nutshell, how do you get to those more accurate performance measures? The first thing you need to distinguish is between just the overall returns you're getting at the total money multiple, the TVPI or MOIC, and then the performance that's essentially left over if you take out the broad market swings. Why you want to take out the broad market swings? Because in essence, that's just a measure of an opportunity cost to the limited partner. If that capital call comes, you got to give your GP some money, and that money is no longer available to be invested elsewhere in the portfolio until the distribution comes back. And that's a real opportunity cost. That's a real foregone opportunity. And I just proxy the cost of this opportunity with the returns to very broad global equity indices, like the MSCI Global, for instance. And if you go from the normal money multiple, the TVPI, to our Parax multiple, the multiple net of this opportunity cost, in the normal days when the markets are positive, that Parax multiple will be lower because there's indeed a positive opportunity cost. But you can imagine, or we all have lived through times where that opportunity cost was actually negative. GPs forcing you to make a big capital call, respond to a big capital call in the peak in the middle of 2008, you should actually be thankful because they, in essence, forced you to sell more liquid stuff and protected you from suffering the downturn. So with this notion in mind, you can then proceed to calculate our two measures of annual performance. And the trick here to avoid all the IRR issues is to not reason about the private equity fund that runs 8, 10, 12 years. Well, we know that the money isn't working for 12 years. It's gradually put to work. It's gradually returned. And so all the IRR measures and their variations fail because they have to make some assumptions while the money is not invested by that fund. I look at this and say, I don't care if I want to assess a GP. I don't care what the money is doing while it's not working with the GP. I actually care about what it's doing when it's invested by the GP. And so I can just measure for how long it was actually put to work. So I explicitly measure the duration of that fund. I look at all the dates of the takedowns, I look at all the dates of the distributions, and I look that for a given fund, let's say this money was put to work for 3 years, 4 years, 5 years, depending on the nature of deals that have been done. In this example, it's a 4.4-year duration. And so you can just ask the question, well, to get to my absolute money multiple of 2.6x over 4.5 years, what annual money multiplication does this correspond to? That's 26%, that's the Parax rate of return. If you look at the same concept relatively, after having taken out the opportunity cost, you go from the Parax multiple to that alpha by asking the question, over 4.4 years, what annual money multiplication do you need to get to the 2.1x? That's 18%. That's the performance measure that I propose as an accurate measure of annual performance in excess of the broad market swings. Now, why do we care about this performance measure? This performance measure is not subject to the IRR bias, and it's not subject to just the distortion of whether the markets have been uplifting people up or depressing performance. And importantly, if we want to understand the value add of a general partner, that's what really counts, right? The GP should not be assessed based on, what the market's doing around them or whatever methodological bias may be there. They really should be assessed based on Parax alpha. And the important and good news is if you switch from IRR to this more accurate performance measure, you actually have, very importantly, a different view on the performance of the asset class. And the first thing that you see is that you have a difference in classifications of GPs based on being top quartile or not. So here I took roughly 1,000 funds. I classified them within this database according to quartile status based on IRR. And then I reclassified them based on that Parax alpha that we spoke about. Now, if the two performance measures would tell you the same thing, you would expect 100% figures there in that diagonal line that's highlighted in yellow. Because you would say, well, if you're top quartile in IRR, you should also be top quartile in alpha. The bad news for IRR is this is not the case. You can see that there's a substantial amount of funds who look top quartile based on IRR, and they drop out of the top quartile if you switch to the better performance measure. And on the other side of that same coin is there are second or third quartile players, according to IRR, who are unduly punished because they really belong on the top quartile based on alpha. So you as LPs are systematically misled by IRR in 26% of the cases because you don't get the view for the actual outperformers in the industry. Now that may be interesting, but the question is whether it's really relevant for your ability to build outperforming portfolios. So we look at this performance measure and see, first of all, how the degree of misclassification varies from one vintage year to the other. But then most importantly, whether with a better performance measure, you actually get to performance persistence. On this statistic, you see the link between past performance based on alpha and future performance, future fund performance based on alpha. And you see a very strong positive correlation that is strongly statistically significant. Now, so there seems to be something going on there with Parax alpha persisting where IRR is not persisting. Question is then, what may be driving this difference between IRR and alpha? And one of the things that I mentioned is alpha is kind of taking performance net of the broad market swings. Here we look at is in essence the degree to which performance was market driven, to which IRR was market driven between the predecessor fund and the follow-on fund. And that flat curve on the left of the chart tells you the market swings are basically randomly distributed. They happen, they may not happen. It has nothing to do with GP skill. That explains why performance persistence is no longer there based on IRR. There were dramatic market shifts in the last 10, 15 years. They lifted some funds up. They depressed the performance of some follow-on funds. That distorts the picture. This is why, based on IRR, you no longer find persistence. A measure like the Parax alpha, which isolates the actual value add of the GPs from the broad market swings, absolutely still gets you that statistically significant persistence. Now, what does it ultimately mean for your ability to hit the top quartile going forward? If you were to look at all vintages based on past IRR, you see on the top left on the chart, it used to be that backing a top quartile player based on IRR gives you 1/3 higher likelihood than average to again find a top quartile player. That was the old days across all vintages. In the more recent vintage years that we can already assess, that basically power of IRR persistence is dramatically decreasing. It goes down to 12% higher likelihood. That's just statistical noise. Looking at Parax alpha, however, you see that across all time periods, there is a substantially higher likelihood of hitting the top quartile by backing players who used to be top quartile according to that performance measure. Now, the ultimate question is, what does this do possibly to your portfolio returns? The answer there is, again, looking at only top quartile players based on IRR, there is no change in the performance of your portfolio going forward. It's basically random. It doesn't tell you anything. You may have chosen different funds, you would have gotten the same performance. If, however, you use those more accurate performance measures for portfolio construction, you systematically screen who was top quartile based on Parax alpha or the Parax multiple in the past, you get a substantially higher performing portfolio. And that outperformance of the portfolio you select by backing funds raised by historically top quartile players based on these performance measures can be in the neighborhood of 500 basis points. So that's a meaningful number for all LPs that I know and I'm working with. This is net of fees. So I think there's lots of reasons for limited partners to switch to those smarter performance measures in the fund assessment. So in a nutshell, on the performance side of things, it's really important to realize that the history is, the world has changed. There's no longer any ability to obtain outperformance by backing past performance based on IRR. You need to look more closely. You need to look at performance net of broad public market swings without the IRR bias, and then you will be rewarded by the possibility of having really substantially and statistically meaningful increases in performance in your portfolio. Another element to look at in terms of portfolio construction and fund selection is, of course, the riskiness of the underlying investments. That's a big theme, very close to many people's heart who are investing in alternative assets. I'd like to focus on one very particular type of risk here that I think is very relevant for the question of fund selection in private equity, in particular in the buyout space. And that is not so much the risk of kind of volatility of performance across time. If you're in private equity, it may be important for your reporting purposes what the asset is worth today versus what it's worth next quarter. But to assess a general partner, I would say it's private equity. It's about the long-term returns. And so I focus on the dimension of risk that comes from the dispersion of performance within your portfolio. In essence, asking the question, how sensitive is the performance of the fund to the 1, 2, 3 best deals or to the 1, 2, 3 least successful transactions? And the methodology I propose here is something I borrowed from my colleagues in macroeconomics. They draw these things called the Lorenz Curve that you may have seen somewhere, and they basically draw this by trying to figure out inequality across different countries. It has nothing to do with private equity. And the way to do is you sort all the people in the country from the poorest to the richest, and then you count cumulatively what share of overall income is owned by the poorest 10, 20, 30%. So on this chart, the 40% poorest Brazilians own 10% of Brazilian income. The 40% poorest Chinese, the orange curve, own 25% of Chinese income. If everybody had the exact same income share, at least economics, that's the perfect state of the world, we would be living on that blue line in the diagonal in the middle. And then they kind of capture this quantitatively by kind of measuring the average distance of those curves from that diagonal line and call this a Gini coefficient. Now, you're wondering why on earth I talk about Chinese and Brazilians, because that's a methodology that you can use to measure and benchmark the risk of your private equity portfolios. Here I'm using this methodology to look at the dispersion of funds in your portfolio. So I'm no longer worrying about individuals, but I take your funds, I sort them from the least successful to the most successful, based on NPV, based on alpha, and then I plot a curve with the cumulative performance of the least performing XYZ funds. And you get that concave curve. It'll be downward sloping if you have loss-making funds. It's going to flatten out at the vertex somewhere. It's going to then break even at some point, and to the right-hand side of that curve, you see how much of the overall returns are driven by just a few very high-performing investments. That concept can be used to contrast your portfolio as an LP with the competitor's portfolio, or against the universe of all funds given in a certain area in private equity land. And just as much as you'd like to say, this is the performance of my 2005 vintage funds against the performance benchmark of my 2005 vintage fund, you can imagine a curve, a risk curve, and a risk coefficient of your own private equity portfolio compared to a benchmark of funds that would have the same characteristics than those that you did invest in. So you can really try and add that risk perspective into the assessment of your own private equity portfolios and see, on which assets, in which subsegments of private equity risk has been higher or lower. The very same process can be applied to assessing the risk of a given private equity fund manager. We got the same chart, but now we're not measuring the performance dispersion of funds in your portfolio. We're measuring the performance distribution of deals in a given private equity fund. And again, we're drawing the curve, and you can see in a practical example here, this is from one of the firms we're working with. The blue line is their risk curve. And you can eyeball there also the ratio of winners to losers, the cumulative amount of loss makers in terms of alpha, so value generation against the broad markets. And you can also use this to benchmark that particular fund manager against a reference points of a large sample of deals in the same area of private equity land. And you could look at them, for instance, and say, well, they seem to have a much more balanced risk profile than the reference group. We can push this further by saying, okay, this is now one GP. The two blue lines correspond to two different funds from that GP. And you can say, not only do they seem to be much more uniformly distributed, much more balanced in terms of the return distribution, but also if you go from one fund to the next, if you go from dark blue to light blue, you actually see the curve becomes more closely resembling the diagonal line, thereby more stable in terms of the risk pattern. And then just as much as that Gini coefficient measures the shape of the curve in macroeconomics, we have a risk coefficient that allows you to quantify it, and you see there as well, if you go from Fund 5 to Fund 6, there's actually a more balanced distribution of returns. That's a very easy way for you to integrate risk in your fund selection, because you can now compare and contrast the riskiness of every single private equity fund out there. You can look at the GP from the perspective of understanding how do they manage risk over time. Do things get more skewed in terms of performance distribution? Do they get, like here, more uniformly distributed? And that allows you to integrate that into your fund selection approach. Interestingly, of course, now we have a good measure of private equity performance and a good measure of private equity risk. And the question is, how do the two correlate? You have on the horizontal axis the distribution of alpha, of performance of 150 fund managers that I've analyzed. You have on the horizontal axis the risk coefficient of those 150 fund managers. And you see a somewhat surprising finding that there seems to be a negative risk-return correlation in private equity. Now that is counterintuitive to everybody else who's used to other asset classes. And I promise you, I checked the math 1,000 times. There's no sign error anywhere in my calculation. But still, private equity seems to be characterized by a negative risk-return profile. The good GPs give you higher returns at a more stable return distribution. Now, why can this be possible in private equity? It is not an efficient asset class. You don't have to accept more risk if you want higher returns. These are discrete deals done by active managers. And the really good GPs are good at both, adding value and avoiding catastrophes. And the not so good GPs, they are not value adding on the average, and they're having more catastrophes in their portfolio. So that's another element that basically says, you know, there's a lot of importance to fund selection, manager selection, private equity. And as this is a GP feature, that type of risk characteristics also persists. So that's also something that you should look at and analyze from the past in order to get some insights for the future. So in summary, what is, to me, the implication of this research? First of all, it's very important that if you look for performance persistence, don't trust IRR, switch to smarter performance measures like this Parax Alpha introduced, and you will be able to find future outperformance. If you're an LP who try to get the handle on risk, well, try to consider that risk curve approach to benchmark your own portfolio and also assess the general partnerships. And then overall, also as a limited partner, of course, if you look for outperformance, strongly suggest to switch from the IRR performance measure to something smarter that's not subject to biases and not influenced by public market swings. Thank you very much for your attention. To the extent we have time, I'll be happy to take a few questions. And there's a microphone in the back if you want to raise your hand. Yep. So, okay, sorry.
Who has a question?
You do.
Hi, thank you. Can you address the modified IRR calculation? Because with that, you can put in your own reinvestment rate assumption, just write in Excel, because without having your methodology.
It's one of the modified IRR is one of the many existing fixes to the IRR problem. You can indeed set your own reinvestment rate, and you can say, for instance, just as much as I say, I assume my reference point is the liquid equity portfolio. You can plug that in. The problem with the modified IRR is that over very long time periods, the performance you observe will converge towards your reinvestment hypothesis. And that's methodologically very cumbersome because you basically get a performance measure for that GP that's a function of what they actually did when they invested the money and what your reinvestment assumption is while you're not getting the money. It's a performance measure I like much better than the IRR, and I used it a lot. I still believe going through the trick of just focusing on the duration, i.e. the money that was really put to work, gives you a cleaner account of what the GP has done, because that rate of return I proposed here is not at all influenced by anything you may have assumed about what the money is doing while you get it back from the GP.